Good afternoon and welcome to our fourth session, Macroeconomics of a Novel Crisis, featuring Professor Carmen Reinhart of the Harvard Kennedy School. Our moderator is HBS Professor Laura Alfaro. If you have reactions to the conversations, you're welcome to put them on chat. Please note that a recording of the session will be made available to a broader session, to a broader public audience. If during the Q&A, you're called on to pose a question, and please raise your hand if you want to do that, your name and voice will be part of that recording. Handing it over to you, Laura.
Hi, Willie. Thank you. So now we go into economics. So what started as a health shock, a virus, as we all know, became an economic problem, an economic crisis, now a world war crisis. The IMF has just recently put out some numbers. They now expect this to be worse than the Great Depression, and many analysts believe these are estimates on the optimistic side. So we're gonna try to discuss the economic consequences. And for this, I have the great pleasure to have and introduce Carmen Reinhart. So Carmen is the Minos Zombanikis Professor of International Finance Systems at the Harvard Kennedy School. She was also visiting the finance unit last term. Carmen was Senior Policy Advisor and Deputy Director at the IMF. She was also member of the Economic Advisors to the Congressional Budget Office. She was also Chief Economist at Bear Stearns in the 80s, and so first-handed the defaults of the 80s and the lost decade in emerging markets. She's also member of the Federal Reserve Bank Advisory Board. She's one of the most cited economists worldwide. She has received many awards, the Adam Smith Award recently, the King Juan Carlos Prize. She's listed as Bloomberg most influential people in finance, foreign policy, global thinkers. And the reason why Carmen's work is so influential is because she has defined the way we understand financial crisis in industrialized countries, in emerging markets. Her work is detailed, exhaustive, comprehensive, across time, across countries. And again, let's emphasize, this has become a worldwide crisis. Her best-selling book, which of course I have in my office, This Time is Different, 8 Centuries of Financial Folly. It's encyclopedic in a good way, perhaps also prophetic, has been translated in 20 languages, has won many prizes. Every news outlet you read right now has a piece by Carmen. Every country is trying to get her views. So Carmen, thank you very much to make time to talk to us.
Hi, can you hear me?
Yes.
Okay. Thank you for inviting me, and thank you for that wonderful introduction. Thank you.
No, as I said, it's an honor. We have a lot of things to cover. But let me start with a recent piece you wrote for Project Syndicate. This time is truly different. Can you give us a sense of how this crisis is evolving, a comparative sense, again, in economic and financial terms?
So the first thing I'd like to mention is, pandemics, unfortunately, are not new in history. We've had a lot of pandemics through the course of history. To start with one that is referenced very often in the current press is the 1918 to 1920 Spanish influenza. And what motivated me also to say this time is truly different, or truly is different, is if you look at, starting with the US, if you look at the 1918 pandemic, which holds a record in terms of mortality, it actually offers us very little guidelines on what to expect on the economic front this time around, because the year 1918, when the pandemic deaths peaked in the United States, the US was involved in World War I, and real GDP that year, despite all the casualties, despite the pandemic, grew 9%. And business failures actually were nil. And so we really can't use that as our benchmark. I think a more relevant benchmark to compare what we're going through right now is the global crisis of the 1930s, known otherwise as the Depression. The reason I say that are manifold, but let me just highlight a few of them. Number one, if you go back to the 2008-2009 crisis, which more people obviously have fresh in their mind, it was called global, and it indeed affected the global economy in late 2008, early 2009, but it really was a banking crisis in 11 advanced economies. The US and Europe were really the heart of that crisis. The emerging markets at that time, were badly hit in the end of 2008, beginning of 2009, but proceeded to have a very robust V-shaped recovery. And this was led by China and high commodity prices. So you go back to the 1980s, and that was an emerging market crisis, not an advanced economy crisis. You go to the 1930s, and it is global, affecting both advanced and emerging and developing countries in tandem. So that, to me, is the frame of reference. Other similarities to the 1930s, which were not present in the global financial crisis of 2008, 2009, I've already alluded to. The environment we're facing is one of very depressed commodity prices up until, notwithstanding, and we will see what OPEC really delivers on that score, but we've had, in addition, as the coronavirus wasn't enough, we've had the Saudi-Russian oil war, which has led to plummeting oil prices, depressed commodity prices. This obviously impacts a huge number of commodity producers globally. It also impacts big time the US. We have our emerging market within the US in the context of the energy industry, the oil industry. So number one parallel, it's global, like the 30s, unlike the global financial crisis of 2008, 2009. It is accompanied by depressed commodity prices. That was true during the 1930s. Turning now to another parallel with the 1930s. The WTO a few days ago came out with a forecast for trade growth for 2020 that ranges from what is already a depressing decline, potentially of 13%, to what is a completely out of the box decline of 30, possibly minus 32% global trade. The last time we had a global trade implosion of that magnitude was again in the 1930s. This is multiple standard deviations in terms of annual changes to global trade. So depressed commodity prices, even more depressed global trade, synchronicity of the economic downturn, and last but certainly not least, volatility, financial market volatility. Financial markets have been nothing less than a roller coaster. This is not a seat of the pants statements, if you will. In ongoing work that I have on the history of capital flows with Vincent Reinhart and Christoph Trebisch, we constructed a VIX, that a monthly volatility index for the US stock market that goes back to 1885 monthly. And I would observe that there are two observations in the upper 1% of the VIX in the post-World War II era. That's October 87 and March of this year. The remaining observations of such excessive volatility in financial markets go back to 1929, 1931, 32, 33. So the disarray, if you will, in global capital markets is also much more akin to the 30s than to any other episode that I am aware of.
Thank you, Carmen. And again, this is unprecedented, and the fact that it's global poses additional challenges. Perhaps we've seen policymakers act, but again, are they fighting the last crisis, or do you see policies in the right direction? Some lessons from your work, and again, we've seen policies, fiscal, monetary, employment insurance, a lot done in rich countries, but what is your view of, is this heading in the right direction? Do we need to do more?
Well, let me separate the policy response into two parts. The first part is unique, really unique to this crisis. The IMF just put out its World Economic Outlook in the context of the IMF annual meetings and has called this episode the Great Lockdown. So the fact that we have had synchronous or near synchronous economic lockdowns of this magnitude is a policy response to contain the pandemic that we really haven't seen before. So, and of course, the understanding that this is in the context of saving lives and containing the pandemic, but it is had a massive negative impact on activity at every front. Because, and let's just very briefly highlight how it, obviously, any country that depends on tourism or the service industry associated with human interaction of almost any form is in standstill. Countries that rely on manufacturing are seeing supply chains disrupted. Countries that rely on commodity exports are finding that because of the crash in global demand, commodity prices are extremely depressed. So no one really escapes it. And in terms of the policy response, the second part of it, not the one associated with containment of the epidemic, the stimulus. So where does that factor in as a response? I have not seen stimulus packages like what we are seeing outside of major wars. So this is in terms of the sheer scale as a percent of GDP, that the magnitude, that's the first thing, the magnitude of the response is on a scale that you really haven't seen increases in government spending and deficits like what we're going to record in a large swath of countries in peacetime. That's on scale. So direction now in terms of mix and monetary policy, that's what I'll turn to next. This crisis, the IMF is calling it the Great Lockdown. I would call it the Great Implosion, because one feature that's very unique to this crisis, and this bears importantly on the policy response question, Laura, that you asked me, is its suddenness. If you look at US unemployment claims, it took us in the global financial crisis 29 weeks to get to where we've gotten in 3 weeks. If you look at capital flows to emerging markets, I just did that using the IIF data on weekly flows. During the global financial crisis of 2008, 2009, the implosion in those flows that we've seen took about a year to materialize, to unfold. We've seen it in 5 weeks. So what this highlights in terms of the policy response is that the policy response has to be immediate. It has to be front-loaded. And in that regard, I think the US policy response certainly scores highly in that, unlike more, if you will, conventional fiscal stimulus, such as investment programs, more gradual creation of jobs and so on in the public sector and the like, that won't cut it when you have a decline this abrupt in people's incomes. So, as you know, phase one of the US policy response was largely, smaller in scale, and it was targeted towards providing support to the medical issue at large, dealing with the pandemic. The second wave was also importantly addressing the fact that people are suddenly, as I mentioned, as I alluded to, the massive spike in jobless claims and unemployment, dealing with potential cash shortages for those households that have little by way of saving to rely on during this very difficult time. So on the front-loaded, fast-acting front, I think it's very appropriate. Let me turn to the leg three, if you will, of the stimulus, which provides basically the resources, and now I'm coming to monetary policy, for the Federal Reserve to be able to finance the segments of the economy that are particularly hard hit, which is almost every sector in varying degrees, by the economic implosion. The initial response of the Fed, I was listening as Chairman Jay Powell was speaking, say, okay, we're cutting interest rates to zero. I say, okay, that's great, but that's not what we need. I mean, yes, lower interest rates are, of course, part of the story, but this is now a crisis. I alluded to already to the severity of the turbulence in financial markets and the volatility, where large chunks of the economy have been left without access to credit. And therefore, the appropriate policy response is beyond your conventional interest rate response, and certainly beyond, QE, as we knew it back in 2008, 2009, and thereafter, was unconventional then. It's pretty conventional now. So the new element, if you will, of unconventional policies that we're seeing to support activity is the establishment of a multitude of facilities that try to reach out to segments like the municipal market, segments where banks that had a very healthy loan portfolio before COVID, that all of a sudden find themselves with a fresh batch of non-performing loans because their small business loans are in the service sectors that are in standstill. So the creation of new facilities that tries to move away from just providing liquidity to the treasury market is, and to more broadly even some of the AAA or highly rated corporates, is very important in this, because the real problems are not as much in that segment, in that high quality segment of the markets, but we're seeing them, and we're seeing this in the vast gap in yields, the vast gap in performance between the lower grade paper and the high grade corporates. So where does that leave us? Is that sufficient? Well, I'd like to turn for a moment to the international implications of that. The Fed is really the global lender of last resort, more or less. You know, it's not formally, that's not its role, but in the end, the dollar is the dominant currency. We've seen dollar shortages emerge throughout the globe. Where does that leave the international dimension? Well, the Fed, yes, has swap lines with a handful of central banks, but that's not particularly helpful for most of the countries. And what this has created, I think, is a bigger rift between emerging market debt and other high yield debt that is not covered by these new facilities that the Fed is supporting, and the more speculative grade assets. This has very important implications because it means more corporate defaults, and it also means more likely sovereign defaults at the international level. And it is, you know, I think, notwithstanding what I've said about the scale of the stimulus, the speed of the stimulus, and the Fed's efforts to make it more inclusive, I still think at the end, Laura, this will not avoid a big wave of defaults on the corporate side in the more speculative segments. And I am very much afraid at the international level for many sovereigns whose credit ratings are being slashed. Let me just add one element that's particularly important when it comes to talking about countries that don't have the resources that the US or other advanced economies, wealthy economies. These countries are seeing the lockdowns, but really don't have the firepower to do the fiscal stimulus that is necessary to counteract those effects. They certainly also don't have the capacity for their central banks to inject liquidity, credit support to the distressed sector. So I am very concerned about a good chunk of the global economy that's in that situation. And staying on your question, and I'll conclude with this, on the policy response, one of the things that Ken Rogoff and I have been writing about, we did a piece for the Wall Street Journal, we did another one, is trying to get the IMF, World Bank, the official lenders, the G20 to orchestrate a debt standstill for developing and emerging markets. And this goes beyond the proposed standstill on official lending, okay, repayment. It would incorporate the private sector debt, and it would also encompass more countries than what the IMF World Bank proposal has so far, which is more limited to the IDA countries, the poorest countries. I think the need is much broader than just in the poorest countries. I think it cuts a much broader swath across emerging markets as well. Let me stop there on that.
And I do appreciate bringing it to lower and even middle income countries. Even in Costa Rica, where I think we have done great in terms of the health part, I am worried, as you said, that we don't have the physical capacity to do what it takes, because it is very abrupt. I think every country seeing destruction of jobs, economic activity at a level, as you mentioned, that we just have not witnessed. But let's, and I'm sure there's going to be more questions, and if not, I'll follow up in the question section. But let's assume, trying to be optimistic, because after all, we economists don't tend to have that side of us, but let's assume that in 1.5, 2 years, there's a vaccine. How do you see the global economy emerging? There was an early period, people described this as V-shaped recovery. I just don't see this V-shaped recovery. Again, it might be my lack of optimism, but are we heading into an L shape, a lost decade? And what are the implications?
Well, I share very much your concern. I wrote off a V-shaped recovery pretty early on. And the reason for that is not, being, I think, overly pessimistic or overly cautious. I think the reason for that is, if you look at the economic downturn, it has been very synchronous. But the spread of the disease is not synchronous. It first hit China, then hit Europe, it's hitting the US. It really isn't projected to hit many emerging markets until later this year. And so as long as you have the pandemic evolving in part of the globe, the idea that global supply chains that have been disrupted can be normalized quickly, or that people will resume a normal or anything resembling a normal travel schedule and help the tourist industries and the service industries that are connected to that, which is it affects many countries, advanced and emerging. So I think I'm not as negative as an L, okay? But there are certainly very long U's with a very flat bottom. And I think we're in one of those periods, because the damage being done, I alluded to the issue of increasing defaults at the corporate and sovereign level, the issue of severe downgrades, even if you don't quite get to a default event. And those are very difficult hurdles to overcome for many countries. And in the context of the global economy, there is another factor that is worrying me considerably, and it is connected to the U-shaped pattern as opposed to a more, and this, by the way, even if the US and Europe come out of this quicker I think is going to be relative. And let me say that I think the whole concept of the paralysis that we're seeing also will lead to another related type of crisis, which historically often follows on the heels of pandemics, and that is a food crisis. And food crises are very regressive. They have, it's a breakdown of distribution system. It's lack of labor in the agricultural sector, and all the kinds of dislocations that are happening already. I think that also will prolong the recovery. Another factor, if all of this is not sufficient, Robert Schiller, in his work on the aftermath of the Depression of the 30s, highlighted how risk aversion persisted for a while following the height of the crisis. Translate that to economic activity. What does that mean? Are firms going to be investing aggressively? Are they going to be very quick to rehire when uncertainty is as significant as it is likely to remain for some time, as long as the pandemic isn't fully under control? So I'm highlighting, these are not all the issues. I could go on, but these are some of the key elements why I think that a more protracted recovery process is far more likely. And let me, again, I don't want to be overly pessimistic about this. I've highlighted so far corporate defaults. I've highlighted sovereign defaults at the developing and emerging market country level, but I really don't know what's going to happen in Europe in the context of Italy and in the context of Spain. If you recall, the 2008-2009 global financial crisis was first and foremost a banking crisis associated with the housing bubbles in various countries. But that morphed into a debt crisis in periphery Europe. It hit Portugal, it hit Greece, it hit Ireland particularly hard. It also hit Italy and Spain, but the three most affected at that time were Ireland, Greece, and Portugal. Those three countries collectively, those three countries' GDP are a little over a third of Italy's GDP, not to mention the fact if something begins to unfold in Italy, the contagion effects to Spain are very significant. All those uncertainties, all those factors, I think, work in stretching out and delaying recovery.
So with those thoughts, and again, you have given us a lot to think, let me try to open to questions from our students. Willie?
Yes, our first question is from Syed Hasabala, and you'll need to unmute and go ahead, please.
Hi, can you hear me?
Yes.
Yes, I can.
Thank you. Thank you for taking the time and for the insight. Given some of these kind of shocking statistics and the parallel with the Great Depression, I'm just confused kind of looking at the S&P only being down 15% since the February 2019 high. And I was just wondering what you kind of make of that. Thanks again.
So, look, I think this is not over. So, predicting equity prices is never been one of my fortes, to put it gently. But let me say the following. I think the reality of some of the factors I've alluded to, the incidence of more defaults, the protracted nature of the problem, I am not sure that that is being priced into earnings expectations. I am not sure that the full extent of the damage on a more sustained basis at this moment is still reflected in equity prices. I will say that in any scenario, you're going to have investors that are in a world of zero or negative interest rates, whether you're looking at the US or whether you're looking at Europe and Japan. There's always going to be a search for yield. So I'm not saying the equity market is you know, I'm not speaking of an L, but I am, I think, saying that the duration and the magnitude of this downturn is still not fully expected. If you look at many of the private forecasts, they have atrocious numbers for, you know, the first half of this year, pretty much across the board, different orders of magnitude, but you turn to the later forecast and you see what is more still the expectation of a more robust comeback. And so all I can say with regard to the equity market is, you know, again, highlighting that forecasting equity prices is hardly my forte, but that the seriousness is not yet fully priced in. Lots of big negatives in the first half, but still you turn to the later forecast. If you recall, as a last point, if you recall the rocky period post 2008, 2009, you remember we had, as I mentioned earlier, the big initial shock of the banking crisis, which generated a lot of turmoil in financial markets. And then you had the second round associated with the European periphery problems, which created another round. That's, I think, what my sense is at the moment.
Okay, our next question is from Alice Liu. Go ahead, Alice.
Thank you, Carmen. I was wondering if you could elaborate more on the banking systems, the crisis impact on the banking system and how banks are expected to react.
So that's also a really big unknown, okay? There is a big rift or a big division, a big segmentation post Dodd-Frank regulation legacy of the previous crisis. So after the last crisis, we had thousands of pages of banking regulation, which it did make the banks much healthier, but it also, because of, you know, increased stress testing, increased emphasis on liquidity, made the banks a lot more risk averse and much less likely to take arbitrage opportunities, possibly the way they would have absent all the regulatory changes. So you have banks that are, you know, initially, as I said, pre-COVID, were quite healthy for the most part. It's much more uneven in the context of Europe. In the case of emerging markets, I would point out that China already had a lot of problems resulting from having slowed from double-digit average growth to around 6% growth. And there was a major, it is the most leveraged corporate sector. So banks, of course, are exposed to a huge amount of non-performing debt. So in the US, you have a new wave of non-performing debt. In Europe, you have a mix of old and new non-performing debt. And in China, you have also a mix of old and new non-performing debt. I'm highlighting this because this really encompasses the good chunk of the global economy, those three groups. What I'm getting at is we are going to be facing a banking sector where a legacy, unless they are explicitly pressured into doing that, of a formal banking sector that is very risk averse and not likely to be very forthcoming on new lending for some time. This impacts the recovery prospect in the way that I described earlier of making it more likely to be a protracted U rather than a V. So we have, to sum up, we have a banking sector where even if you didn't have problems before, has problems now, even notwithstanding what are very big facilities to support those banks from the Federal Reserve. But I think, also harking back to an earlier remark, I think the sense of risk aversion is going to be a factor that is going to hold back renewed surge in credit after this shock. Let me contrast two, and I'll conclude there. Let me contrast two very different experiences. In 2008, 2009, part of the very robust comeback, after only a very brief slowdown in China, was the surge in credit to the private sector. In Europe, by contrast, you look at the Bank of International Settlements, BIS, credit gaps, and it told you the credit crunch in Europe from banks just evergreening old loans but not making new ones has lasted for years. The US was somewhere in between those two, okay? So I think our financial system is going to bear scars for some time and is not likely to be a very robust catalyst over the next year.
I think we have time for one quick question. Vinod Mittal. Vinod, you have to unmute. Vinod. Okay, let's go to Justin Troani. Please unmute yourself.
Hi, Professor Reinhart. You spoke about the Federal Reserve and Chair Powell's response. I'm curious what your thoughts are of the Fed moving up the risk curve, now supporting fallen angels and sort of some high yield credit, at the same time growing their balance sheet from roughly $4.5 trillion to upwards of 10 trillion. So how much is too much, and at what point should we start to worry about the long-term effects of a risky balance sheet and maybe the moral hazard that this has created? Thank you.
Okay, so it is a slippery slope, Justin. It is a slippery slope. I mean, the Federal Reserve is now entering new ground on moving more and more towards the lower quality end. And look, I think the concern that this crisis, and this shares many similarities to prior historic ones, ultimately the costs are socialized. ultimately, we all pay for it. I think the issue of moral hazard is one that we tend to worry about more in normal times than we do in crisis times. And we see that again and again. You know, policymakers blink in a moment of stress because the contagion fear typically has dominated the concerns about what it does in the future to moral hazard. In terms of the balance sheet, let me say this. The ECB has been buying non-performing assets for many years now. The Federal Reserve actually is coming in later to that game. Let me say that I do not expect by any stretch of the imagination that central bank balance sheets are not going to remain exceptionally large by any metric for the foreseeable future. That may be closer to the L than the U. What I'm getting at, Justin, is that first of all, lower asset quality in central bank balance sheet. It's hardly new to this crisis. As I said, the ECB has a lot of experience on that score. And ultimately, you know, it will be the Fed, as you know, transfers whatever profits it has to the Treasury. Whatever losses will ultimately be transferred to the Treasury. Ultimately, it will be socialized.
So, sadly, we have run out of time. We could be discussing this for longer. This is the mother of all crises. Thank you, Carmen, for taking time to talk to us. This time is truly different. Perhaps some good news. Policy makers are acting, but this is truly global. Every person, every market, every country. And so we need to think how to reach all of these affected sectors. A call for coordination. I think it will be hard if we don't coordinate and think broadly. To our students, for all of you who have taken Biggie, you are living Biggie times. And so an understanding of the economic and financial consequences will be crucial in your career as this crisis unfolds and eventually as we get out. Thank you very much, and I hope you enjoy the rest of the day.
Thank you, Carmen Reinhart and Laura Alfaro, for a great session. The current webinar session is about to end. To join the next section, you'll need to log back into this webinar using the same Zoom link you used previously. The next session starts promptly at 2:15 p.m., so be sure to log back in by that time. Thanks and see you soon.